Our next speaker is another veteran to the industry. One of the most interesting individuals around. Yet again, another dear friend of ChainSafe's, CEO and founder of Informal Systems and Cosmos, Ethan Buchman. Ethan, go ahead and turn on your cam and mic and join me on the main stage.
Woo! Thanks for having me.
Hey, Ethan, how you doing today?
I'm great. How you doing?
I'm doing well. The stage is yours.
All right. I got to share screen here. Very good. All right. Thanks, everyone. Thanks so much to the ChainSafe team for having me out. I am Ethan Buchman. I am the co-founder of the Cosmos project. I'm CEO of Informal Systems. Informal is building interchain infrastructure to support localism. I know that I think I'm on the schedule talking about the future of Cosmos, but Aiden told me I could talk about whatever I want. And these days I'm a little bit obsessed with banking. And I've been like trying to total amateur economist and banking historian, but I've been reading a lot recently. And so I have kind of put together a little bit of a history of banking and central banking, partially because I want to understand it better, but also because it's very closely related to why I'm in this space. So about a week ago or so, I published a tweet thread that sort of summarized why I'm here and what I think we're doing. And the context is basically that, as far as I understand, the international financial system at all levels is structurally unsound and unsustainable. And this seems to be primarily the result of how we approach money and banking. The highly centralized bank debt nature of money, the way money is so inequitably issued and distributed, and this huge gap between the real world and the financial world. And in my understanding, soundness and sustainability are actually strongly associated with localism, with greater self-sufficiency in communities, with smaller radius supply chains, with more democratic decision-making and ownership, a lot of things that we tend to regard as decentralization, but maybe more concretely, it's about localism and sovereignty. And there's always been more localist alternatives out there to finance. There's mutual credit systems and credit unions and time banks and lending circles and so on. But I think traditionally they've struggled to scale. And scaling a financial system is a matter of scaling trust across communities, right? And money emerges as this kind of vehicle for and reflection of the process of scaling trust across communities. And I think as far as I can tell today, blockchains and cryptocurrencies provide the most credible foundation yet for attacking this problem of formulating and scaling new money systems, which is why I've been so drawn to them. But ultimately, that is to say that, money is the killer app. And despite what everyone's going to tell you about all the great things blockchains can do, which I will not deny, at the heart of it all, it seems like the most important opportunity ahead of us is to reformulate money and the financial system. And so I would posit that our goal with this technology really must be to evolve a more sound and sustainable international financial regime that bridges the gap from local to global money and back. And that this is really the crux of what I think about when I think about why we're building this infrastructure and what it's for. So, of course, that means Ethereum is a complete scam. No, I'm just kidding. Ethereum is materially transformative technology that has unleashed invaluable experimentation in political economics. And while a good chunk of the last 100 years was about how economics is this like objective, independent science, devoid of politics and any other stuff, that's obviously false and has wreaked tremendous havoc on our world and on our ecology. And these experiments in political economics happening on Ethereum, I think, are sort of rekindling an understanding of the profound interconnection between political institutions and economic institutions that we really need to take heed of, as we move into the future to build a sustainable society. And so while today, a lot of the stuff on Ethereum quacks like a casino scam, the mechanisms being pioneered there of bonding curves and automated market makers and lending protocols and so on, I really think are going to revolutionize financial, economic, and political institutions. And not just by making them more transparent and accessible, but by really transforming the theory of finance as well. And so you have things like MakerDAO out there today, which is, as far as everyone can tell, is very clearly a central bank functioning on a decentralized ledger, which is kind of an amazing thing for this community to be sort of rediscovering central banking from first principles by putting out an interesting system and then figuring out how to govern it. Just like a central bank, there's a price target, right, which is the $1 die. Just like central banks have their inflation targets of 2% or whatever, there are mechanisms for manipulating things, changing the interest rates the maker holders vote on, and so on. And so there's a lot to learn from central banking about how how a system like Maker should be governed. But while Maker is super interesting, and there's a lot of interesting parallels to draw on there, I don't think it materially changes much, right? It's still a global dollar-based system. Yes, it's decentralized. There's decentralized governance. That's all cool and good. But I think we need to go much further than that, than just making things slightly more transparent. And that was really a big part of the vision behind Cosmos, was to make the kind of transformative tech being pioneered on Ethereum more accessible through these values of interoperable sovereignty, of enabling a proliferation of blockchains that are owned and operated by independent communities that are sovereign in their own regard, and then still having those communities be interoperable with one another. And I really think this kind of localism is actually necessary both for technical and social scalability. And this idea of like a single global computer just isn't going to cut it. It doesn't fit what we actually need to be a sustainable society. And so there's kind of a fatalism around money, around the history of money, that's like, oh, we're kind of stuck with what we have and it's going to be really hard to change things. And that might be true, but the explosion we're seeing in cryptocurrency technology with each cryptocurrency launching is effectively it's a new money, right? And there's all this, we're in this kind of Hayekian competitive market for money where all these new monies are emerging, and there isn't really any kind of like coherent understanding behind them. Everyone is just competing for market share, either with better technology or funnier memes, or what have you. And so, I've been trying to understand a little bit more about the history and the science and the theory behind this, and I'm still, a complete amateur. But I'm sort of diving in a little more into economics, and my background was more in sort of biophysics. That's what I studied in university, and a little bit of ecology. And so a lot of my intuitions behind economics are grounded in ecology. And it's actually really interesting that economics and ecology come from the same root, which is eco, which means home. Ecology being the study of the home, and economics being the management of the home. But ironically, I think these two things have kind of swapped, right? Economics has become this like abstract study of the home system. And the result of that economic policy and so on has been like complete devastation of the global ecology. And the ecologists are now trying to clean up that mess and actually take care of the home. So they're, in some sense, the home managers. But in any case, it felt like it would be interesting to dive in a little bit into sort of the history of central banking and try to understand, in the context of if money is really the killer app, and if we're really going to transform the financial system to make it more sustainable, to bridge the gap from local to global money and back, we should probably understand what came first. So most of the rest of the talk then is going to be a little bit about that history. So where to begin? Well, a natural place to begin is the Bank of England. Not that it was the first bank or even the first central bank, but it really became the sort of model for central banking across the world. And of course, London was the center of international finance globally. And so the Bank of England held a kind of privileged position. So the Bank of England came to ultimately rest on Threadneedle Street and came to be known as the Old Lady of Threadneedle Street, epitomized in this cartoon from the 1800s, where the prime minister is raiding the old lady's pockets for gold. And the old lady is sitting there, kind of hands up in the air, sitting on her chest of gold, her reserve chest of gold, and she's wearing a gown made out of paper money. And this was a political cartoon in protest of the emergence of paper money in Britain, and this like constant tension between the government and the central bank, and the government needing to kind of raid the central bank to finance itself, essentially, right? So where did the Bank of England get its start? Well, as you might expect, it was to finance war. So in the late 1600s, England had been devastated by a war with the French, and they wanted to build up their own, world-class navy. And so they needed to raise money to do this, but their credit was very poor, and so no one wanted to give them money. And so they said, okay, we will set up a bank, and we'll call it the Bank of England, and we'll give it the right to issue notes and to be the government's banker, and then maybe you'll give us money. And that worked. And so this new Bank of England, it wasn't really a central bank yet in the sort of common lender of last resort understanding, but it was able to raise money. And it evolved over history, and there's a long, interesting history. But it was really in the 1800s that this notion of the lender of last resort came together and was kind of formalized, in particular by a journalist and businessman in England named Walter Bagehot. And the idea of the lender of last resort, at least as he formalized it, which was kind of, somewhat hard to disagree with, and is kind of a responsible articulation of what a central bank should do, is the idea that they should lend freely at high interest rates to solvent firms with good collateral, right? And that sounds like a pretty good way to backstop a banking crisis, where there's a crisis of liquidity and banks need cash, and the central bank steps in and says, look, we'll give anyone who needs it. We're going to charge you a very high interest rate. We're only going to help you out if you are actually solvent, like you're not a bad business, you're just illiquid for whatever reason, and you have good collateral. And that was sort of the dominant paradigm at least in the 1800s. And of course, we've come a long way from them with, Federal Reserve and central banks today lending freely at very low interest rates or even negative interest rates to completely insolvent firms with terrible collateral. So that's unfortunate. But anyways, there's a very rich history of central banking in Europe. And if you look at sort of the German central bank and the French central bank and the English central bank, they really came to dominate kind of European finances and history for a few hundred years. But maybe more interesting is what happens when you cross the Atlantic. So the U.S. has a fascinating checkered history with central banking. It had central banks and then lost them multiple times before it got the Federal Reserve. And the sort of pioneer of central banking in the U.S. was Alexander Hamilton. And so I sort of consider the first phase of central banking the Hamilton phase. And then after, when they lost their central bank, I'll tell you why in a minute, we entered into this sort of wildcat banking phase. And because I'm a sucker for good slide titles, I sort of combine those two phases into the Hamilton Wildcats, which if you're from Ontario, you may know is the name of a football team here. So they have absolutely nothing to do with banking unless there are some shady anecdotes I don't know anything about. But the first two phases of American banking are something like the Hamilton phase and the Wildcat phase. Anyway, where did it all start? Well, not unsurprisingly, the U.S. needed to, the pre-U.S., the Continental Congress or whatever, needed to finance its War of Independence. And so they printed money. What else is new? And they printed a lot of these things. These are called continental currencies, and they won the war, but there was heavy inflation, and the continental currency lost 99% of its value. And so in the early U.S., they had to set up, they set up their government, and in their constitution, they were like, no, the government cannot print money. That's bad. Okay. So that was off to a good start. But Alexander Hamilton, who was the first first secretary of the Treasury, was really eager to set up a central bank and to have predominantly to clean up the mess of war debt. From the Revolutionary War. And so they did that. But interestingly, the first central bank, because there was a lot of opposition to it, Americans were very suspicious of central banking at the time, and for good reason. So they put some restrictions on it. So for instance, the central bank couldn't buy government bonds, right? So the government couldn't monetize its debt by having the central bank print money and buy government bonds, which is, probably a good restriction to have in place. Obviously, we don't have that anymore. They also put another restriction in place, which was that the bank would only have a 20-year charter. So the first central bank of the U.S. was only going to last 20 years, and then Congress would have to reapprove it. 20 years came and went. Congress decided not to reapprove the bank. And then the bank had the War of 1812. They racked up a lot more, the U.S. had the War of 1812, racked up a lot more debt. And within a few years, they had the second central bank of the United States, again, modeled after the first, again, with a 20-year charter. 20 years later, Congress would not renew it. The second central bank lost its charter in the so-called bank wars under President Andrew Jackson. And so the U.S. finds itself again without a central bank. And of course, we're talking 150, almost 200 years ago now. You have the same sort of arguments being made in favor and against central banks as you do now. You have the supporters saying, oh, it'll stabilize the economy, it'll smooth out the prices, we need to extend credit, we need a standard currency, we need to manage inflation, all this kind of stuff. And the people against it are like, no, the central bankers are corrupt, and it just favors merchants and Wall Street and speculators at the expense of the farmers and the artisans and the backbone of the country. And so that was the end of central banking in the U.S. for a time. And for the next 20 years, we had basically the period known as wildcat banking, because now the banks, there was no sort of federal oversight. It was just based on state law, state jurisdiction. A lot of the state chartered banks were backed by state bonds, and a lot of those state bonds were junk, and so a lot of those banks failed. There's a period of so-called free banking where it became very easy for banks to set up free as in beer this time, because it was very easy for them to set up banks with sort of no oversight, and a lot of those banks failed. And so this whole period came to be known as sort of wildcat banking because there was no coherence. There was very little trust. All these different banks were issuing notes that were heavily discounted when you tried to cash them in somewhere else because the banks didn't trust each other. So even though they were all called dollars, they weren't traded at par, and so it was a big mess. Of course, 20 years later, or by the end of this period, you get into the 1600s, and the U.S. finds itself needing to finance another war. This time, the Civil War. The Union government needs to finance the Civil War. And so what do? They find a loophole that enables the U.S. government to print money. Finally, they managed to do it. They print this currency. They call it the greenback because the back of it had green ink, which they actually got from Canada, as far as I understand. And so they managed to print themselves, a few $100 million worth of these greenbacks. And I believe I have found here the original money printer go brr meme, printed in 1864, a political cartoon where you have this greenback mill and you have this bureaucrat just churning out greenbacks in the 1800s. And you got a bunch of politicians sitting around the table saying things like, give me more greenbacks. And, this reminds me of a most capital joke. And this is like 150 years ago, right? And the title of this cartoon, Running the Machine, comes from a letter that was written by the Secretary of War after they had lost, I kid you not, the Battle of Bull Run. So the Union had just lost the Battle of Bull Run, and the Secretary of War is like commiserating about how the government is just like running their machine and cranking out greenbacks, and they still can't even win battles against the Bull Run. So it's amazing how history rhymes. Anyway, getting back into it. So the U.S. decided they needed to they needed to nationalize the banking system. They wanted a single national currency and a national bank charter, and they needed to facilitate more raising money for the war. And so they introduced the National Bank Act, which basically took some of the power away from the states and created a nationalized bank charter system so that now you could register national banks. And they introduced a rule that said for those banks to issue notes, they had to be backed by government bonds, right? So long gone were the days where the banks couldn't hold government bonds. Now they were required to, and this helped the government raise a ton of money to fight the Civil War, which of course they would ultimately win. Now, the idea behind this thing was to provide, as well as raising money for the war, was to provide stability. But the next 50 years or so, the late 1800s, the U.S. was riddled with financial instability. Roughly every 10 years or so, there was a major financial panic. And if you try to understand this, a lot of people look at this and are like, well, therefore we need a central bank. We don't have a lender of last resort. Even though we have this national banking system, there's still no central bank that can step in during these liquidity crises and provide funding. And, this Walter Bagehot guy is a smart guy. We should do what the Bank of England is doing and, lend money freely at high interest rates to solvent firms with good collateral. But in the meantime, if you look at it a little more closely, you see that there are a couple things going on. One was this requirement to hold government bonds actually severely hampered the bank's abilities to issue credit, especially as the government tried to start paying back those bonds, right? The value of the bonds would be volatile, they would go up, it would be harder for banks to acquire them as collateral to print more notes. So that sort of exacerbated these credit crunches. There's also this problem where the US banks were not allowed to branch. So every bank, of course there were thousands of them, every one was only a single entity. They weren't allowed to branch, which meant they weren't able to diversify their assets and liabilities, and it was much more difficult for them to coordinate, especially in times of crisis, and they couldn't really spread out, so it was harder for them to move money. And so a lot of people now that proponents of the so-called free banking movement point to this lack of branch banking as pretty much the fundamental reason why there was so much instability in the U.S. banking system. And it wasn't that they needed a central bank; it was that banks just needed to be able to branch. And part of the problem was that because of this lack of branching and because of the reserve requirements, you'd have small banks would keep a lot of their reserves with bigger banks up the chain. So the rural banks would keep reserves in the city banks, and the city banks would keep reserves with the New York banks, and then the New York banks would lend out money to the stockbrokers to speculate, right? Like exactly as you'd expect. And then seasonally, around the harvest season, you would have this increasing demand for cash from the farmers because they need to pay workers, they need to upgrade equipment, whatever it might be. And you would get this rippling effect through the banking system where these farmers calling for cash would cause the rural banks to call in their deposits. Eventually, it would call in the loans to the stockbrokers, and everything would blow up. And this would happen, every fall, and sometimes led to massive panics. But interestingly, these sorts of crises were actually a U.S. specific thing. Other countries that didn't have central banks they would experience the same kind of seasonal, cyclic demand for the currency that would spike in the harvest time and then drop down, but they didn't have the panics resulting from it. And so people look at countries like Canada and countries like Scotland, which during this time had a much more free sort of banking system without these weird regulations against branching, and they didn't have central banks, and they didn't have the regulations on holding government securities, and they were much more stable. And people point to that period as saying, look, it's possible to have a competitive banking system without a central bank that is quite stable and is very elastic to changing demand in the money supply. And so in this graph, it's hard to believe this graph is real, but The dark black is the Canadian money supply, and the light line is the American money supply. And you can see that the Canadian money supply perfectly responding to changes in demand annually during the harvest time, right? And then there's this slow, steady uptick over time, which reflects the growth in the overall economy. But the U.S. Band basically doesn't track that at all, and it's just totally out of whack. It's completely unresponsive, unelastic to these cycles of demand for the currency. And so it really makes you think, like, what is the money is a commodity, it has supply and demand. You need a system that is able to respond at sort of a fine-grained level. And the lack of branch banking, as much as branch banking was thought of as like an evil in the U.S. that all the New York banks would invade, banning it actually had the opposite effect of sort of pyramiding all the reserves in the New York banks and making them much more powerful and much more profitable than there would have been if there were this sort of branch banking. So these panics were happening in the U.S. You had them all the time. And then in 1907, you had the panic of all panics, the panic of 1907, and this really pushed people to be like, okay, we need to do something about this, right? And so the Congress, they created a commission to investigate what's going on. And the commission was led by this Senator Alger, who was basically, in Wall Street's pocket. He was like the father-in-law of J.D. Rockefeller Jr. And he put together a motley crew of bankers, and they escaped to a private island, Jekyll Island, and met in secret and hatched this plan, which would eventually it was known as the Alger Plan at the time, but it would come to lay the foundation for the Federal Reserve. And even though the plan itself was rejected, it had the effect of changing the conversation from should there be a central bank to what kind of central bank should there be? And more or less, even though the initial plan got rejected, the thing that got put in place was basically very similar to the initial plan, and it's the Federal Reserve we know and love, or love to hate today, which is this sort of quasi-decentralized Federal Reserve banking system in the U.S., where you have 12 different Federal Reserve banks, and they're all sort of governed by this government-appointed board of directors or whatever. But in reality, all this really did, even though it was supposed to introduce more stability and so on, the most important thing it did was further entrench the interests of the New York bankers. And of course, when people think or say Federal Reserve, they tend to refer to the New York Federal Reserve, the Federal Reserve Bank in New York, which has become sort of all-powerful in the world. So this was kind of unfortunate, but that happened shortly after the Fed was created in 1913. World War I broke out, and all the European countries went into massive debt, either with each other or to the U.S., and most of the world's gold actually flowed to the U.S. during this time. And then most of the next 20 years are just really about dealing with the mess caused by World War I. It was such a silly war and created so much havoc in the financial system that really the next 20 years were about figuring out how to clean up the war debt, how to deal with the reparations from Germany, which kept defaulting because France was trying to exact an arm and a leg. It was bad news and led pretty directly into the Depression. Something very interesting happened in the Depression, which I call the script, the prescription for depression. So script is a word for local currencies that started emerging, and sort of started trying to bring this back home now because I need to wrap up. So in this huge collapse of the money supply in the Great Depression and this contraction of credit, a number of cities and businesses would start issuing their own currency. They would call this script. That was sort of the word. And they would use this currency because even though the sort of national system had collapsed, there were still people that needed things. There were still businesses that provided things, and they needed a medium exchange to facilitate trade. And so these complementary currencies exploded across the world and really helped facilitate trade and get things started again. But almost everywhere they showed up, they were stamped out by governments and central banks as like a threat to their power and so on. There are two in particular that I wanted to call out because they're particularly interesting. One was in Virgil in Austria, a small town in Austria that introduced a demurrage-based currency. Demurrage meaning there's effectively a negative interest rate. So every day that you hold the currency, you have to add a postage stamp, which incurs a cost, which incentivizes you to actually spend the currency as quickly as you can to keep it flowing. And this thing was so successful, it came to be called the Miracle of Virgil because of how quickly they were able to rebound from the Depression using this demurrage-based currency. Of course, the Austrian central bank, stamped it out, and so it only lasted a year, and then the miracle was over. But something different happened in Switzerland, which was the incorporation of the Veerbank. And the Veerbank also is a complementary currency, but they incorporated it as a bank, so they got a banking license, and they function primarily as a mutual credit system. So to facilitate credit between small and medium-sized businesses. So you can think about every time you have an accounts receivable or accounts payable on your balance sheet, there's an extension of credit between two parties, right? And you can imagine that you can have a network of accounts receivable and accounts payable, and someone else's accounts receivable, could translate into your accounts payable, even if you never had an interaction with them. And that's really what a credit union, what a mutual credit system can facilitate. Is a business signs up, is issued some credit in the Vier franc, which is pegged 1-to-1 to the Swiss franc, but not backed by it, just pegged to it. And the expectation is that that business will then be able to spend those francs into the system, and will then accept them as payment for its own goods and services. And so the Vier Bank is actually still around today. It has thousands of members. It's done billions of dollars in volume, and it's actually the most successful and longest standing complementary currency in the world. So it seems like even though it's sort of declined a little bit over the last couple decades, it seems like there's quite a bit to learn from that. So bringing it back home to blockchains, there is a project I am infatuated with right now. It's called Grassroots Economics, and they have launched something called community inclusion currencies, which I think take a lot of inspiration from things like the Vier Bank, but pair the kind of mutual credit system model with these innovations that are coming out of the blockchain space, like bonding curves, right? And so it's sort of a mix of what you would expect in a traditional sort of hard money backed bank, and in a mutual credit system, where you can actually have a way to put collateral into the system, still have the issuance of credit between small businesses that want to do trade with each other, have that credit be on a bonding curve, so it is somewhat fractionally backed by real money, and that way potential investors and human aid groups and so on can actually help bootstrap these systems. So they have the community inclusion currencies are live in Kenya and I think in a few other places, and they're seeing some amazing results. And so what I am really hoping to see is a proliferation of these kinds of systems, again, drawing more on understanding the history of central banking and money, and especially these kinds of like mutual credit unions like the Vier and these other complementary currency examples, to bootstrap much more local and sustainable financial infrastructure. And of course, again, this has always been sort of my goal with Cosmos, to facilitate an explosion of this kind of technology and to build out ultimately much more local economic systems, and something like a fractal hierarchy of community currencies all connected up to each other through mechanisms like bonding curves, to give us a map from local to global monies and back for a more sustainable foundation for the global financial system. Thank you very much.
Awesome. Thank you so much, Ethan. Great presentation. I'm much more informed on banking history, and I'm definitely happy I was not banking during the Wildcat period. We have a couple questions for you. First one, what period of banking would you want to live through, and what benefit the most from decentralized finance?
What period? I mean, I'm pretty excited about living through the current period. I didn't really get to talk much more about what's happening in the current period, but there's a new class of banks. They're not called banks. They're like Shopify and Wealthsimple. They're called fintech companies, but they're effectively banks exploiting regulatory arbitrage. Not to mention, MakerDAO and all the crypto banking institutions that are sort of popping up. So I think right now is the most exciting time of banking to live through. I hope that's not a cop out, but otherwise I would say late 1800s late 1800s in Canada, where the banking system was super stable and responsive. As far as DeFi, DeFi is cool, but it's also a sham, right? Don't be misled. Like a lot of the DeFi stuff that is out there and being talked about is really about replicating existing financial system products in a slightly more decentralized, transparent way. And not to disparage decentralization or transparency, those are all good, but we need to really get to the core of the problem here. And if you're just building, speculative financial vehicles on Ethereum, as important as that's going to be for the experiments and for understanding what kind of mechanisms we need, it's not really helping real people, right? And this is why I got so excited about that Grassroots project, because even though they are built out on the POA sidechain, so it's Ethereum based, but they are working with real people, with real businesses, and using these mechanisms of bonding curves and so on to actually facilitate trade there, and to help them sort of take control of their local economic situation.
Awesome. The next question seems a bit of a joke, but it has 7 votes, so I have to ask: do you think we would see a return of Tanaki if Cosmos Governance funded his sophomore album?
Yeah, I think so. I think someone should put up a proposal for Tanuki's I don't know. The debut album never got produced, so maybe we should start with the first album. There's probably a few more tracks that need to be written. I would love to take some governance inspired or decided recommendations for which tracks to add. So you can check out github.com/ebuckman/Tanuki for the initial set of candidates for the debut album. And yeah, I would love to take more recommendations and get that thing funded.
Awesome. Last question. I know Informal Systems uses a lot of TLA plus to verify distributed systems. Do you think there's a place for formal verification of economic systems, perhaps using dependently typed theorem provers?
Yeah, I think this is a huge open area of research to understand a formal footing for economic systems. But I would caution heavily that these systems are real economic systems are incredibly complex. And I suspect it's more likely that biological intuition is going to do more for the stability of those systems than like theorem proving, right? Because if you prove the wrong model, like you might prove the model is sound, but it may have no relationship to reality. So as important as sort of, high quality testing and quality assurance and correctness assurance is going to be for the models, even more important will be that they're grounded in like local economic realities. And you can't get that from a theorem prover or TLA.
Awesome. Thank you so much, Ethan. It's been an absolute pleasure.
Thanks for having me.
Take care.